Okay, so this is a homework walkthrough for Module 1 problems. Generally, I put this out on a discussion thread on Wednesday, and this assignment is due on Friday, so that gives you a few days to kind of look it over and then get working on these problems. And usually what I do is I'll pick a problem that is kind of representative of one of the things that you have been assigned for homework, and I'll do a walkthrough of that problem. I'll talk about what it is that I'm thinking about, how I'm making the decisions, walk through the calculations for you, and that kind of thing. That way you can review this before you do the problem, or after you do the problem before you're ready to submit, or anything like that. So in this first week, we have a couple of problems assigned. One of them is 2.6, and so I'm going to do 2.7 because it's very similar, and it'll give you the idea. And so here is the 2.7. Again, you're going to do 2.6 for homework, and this will kind of give you an idea. So given the following information, prepare in good form an income statement for Jonas Brothers Cough Drops. So for the most part, Chapter 2 is kind of like an accounting review, but it could be that maybe you haven't had your accounting class, or it's been a while since you've had an accounting class. And so before we go throughout the rest of the course and kind of identify numbers, what the numbers mean, how to do comparisons, how to do analysis, that type of thing, is you need to kind of understand what are on the four financial statements, as they represent the scorecard, if you will. It's how we keep score in business, is with the four financial statements. So in this case, we're looking at an income statement, which is a very important statement, not only for the corporation, but also anybody like investors or potential lenders that are looking at this company to try to determine how are they doing financially, because that's what the financial statements tell you. So in this particular case, we have some information here. Your textbook will show you the proper form, good form of an income statement. Basically, you're working your way from your sales or your revenue, getting through all of your individual expenses, and then getting down to taxes, and then your earnings after taxes, and so forth. Now, this is a very simplistic income statement. It's very common to have 15, 20 different line items, if not more, in an income statement, but just to kind of give you the idea. So if you're looking at proper form, we want to identify what all of these things are. So sales or revenue, or sometimes if it's a service business, it might be called fees earned. So this is where we're going to start. So if I come down here, holy cow, giving me all these extra little lines. I don't really need that, but hey, what are you going to do? Let's see. That's better. So I'm going to start with sales. So sales is the first number that I am going to put on the income statement. And then it's a matter of eliminating expenses. So if you are an inventory business, if you're a manufacturer, or if you are a retailer, a wholesaler, and you have inventory, as you start listing your expenses that are related to inventory is going to be listed next, and then any of your regular cost of doing business type of expenses, and then specialized things like depreciation, interest, taxes, and so forth. You'll see this whenever you look at a layout of a good form income statement. So basically what we're going to do here is sales we've already used. So we're looking for something related to inventory, so that's the cost of goods sold. Cost of goods sold. And that's $560,000, and this is a subtraction situation. So you're going to take sales minus cost of goods sold, and you're going to get something called gross profit. In other words, just covering the cost of our inventory will get us $1,100,000. In other words, just subtracting those two. Okay. Then at this point, you're going to start eliminating normal cost of doing business. So selling and admin expenses, and that is $328, and depreciation at amortization, that would go here as well too, or depletion. And so this gets you what's called operating profit, operating income. So basically from our normal operations. So here's our sales. This is our cost of the goods that we sold. And that leaves us this. And then we have these two numbers here, which are normal costs of doing business, selling and administrative expenses. So those are things like advertising, utilities, any supervisory costs, payroll, supplies, those types of things. Insurance, taxes, well, not really taxes at this point. Things like sales taxes and that type of deal would be part of your normal cost of doing business. And then from this particular point, if we subtract these two items from this item to get our operating income or operating profit, that will end up, if we do the math, it's $577,000. Now, you don't have to put these spaced lines in here. I'm just doing that to make it a little bit easier to read as I'm going through here. But then we would, from operating profit, we take away interest expense. And that becomes 129. And then we take away, or now what this becomes is earnings before taxes. And so again, we're going to take 129 away from this. It's another math problem here. Boom, 448, and then we have our taxes. And usually in these problems, it's one of two things. They're either going to give you what the tax amount is, you're going to have to go look in an account to find it, or you're going to be given a tax rate, 40% or whatever. And so then whatever, if that's the situation, if you're given a rate, you would just take that rate times where we are, earnings before taxes. Oops. And then you're going to get your taxes. In this case, $171,000 was given to us, and then earnings after taxes. If you ever watch any of those shows, CNBC or any of that, or you're reading any financial press, a lot of times they talk about something called EBITDA. And earnings before interest, depreciation, and taxes. So a lot of times when they're doing comparisons of a company from one period of time to another period, like first quarter last year versus first quarter this year, they'll compare what they call EBITDA numbers, and they're just kind of pronouncing those letters, which are kind of an abbreviation. So earnings after taxes at this point, $277,000, and there we are. And so that's the answer to prepare an income statement with all of these. Now, in some cases, you might be given various numbers and have to calculate some of these things along the way. You might be given a list of selling and general administrative expenses, and then you have to come up with this total. You might be given the amount of debt and the interest rate, and you may have to calculate the interest expense for the period of time. You might be given something like purchases, beginning inventory and ending inventory, and then the number of units sold, and then you may have to calculate cost of goods sold, but in this case they're kind of keeping it simple for us. Alright, so let's move on to Chapter 3. Okay, so in Chapter 3, you were assigned 3-22, and I'm going to show 3-36, or a portion of it, for two reasons. One, this is talking about doing all 13 of the basic ratios found in the chapter, so this is actually a good problem to kind of do for comparison. Anybody that wants to go through the process, I'm going to do a portion of it now, just as it relates to the 3.22 that you have for homework. However, if somebody wants to go through and do the rest of this problem just kind of for practice, you let me know and I will send you the solution so that you can do a double check on it, because this problem has all of the statements. I'm just showing you the balance sheet right now because of what 3.22 covers, but it also has the income statement as well too. So those are the two primary statements that you would use for doing a lot of these ratio calculations. And in this case, we're only going to do some of them that were required. So we had the current ratio, the quick ratio, the debt to total asset ratio, asset turnover, and average collection period. So I want to do some of these calculations for you, so that we can, because some of these ratios are, they tell you something specific about the financial status of the company. So in the first case, current ratio and quick ratio, these are measurements of liquidity. Okay, so again, when you're doing these types of problems, you're going to want to look at the area of the book that shows you what all of the formulas are. That's just the easiest way to do these, is to plug in the formulas. So for let's come down in here and do let's see where here am I gonna, you're gonna give me grief again? Okay, so liquidity. I don't know why you're underlined. You don't need to be underlined, so let's get rid of the underline there. No, you're not going to let me do that, huh? There we go. All right, so liquidity ratios are current and the quick, or what they call the acid test ratio, is kind of like an old version of it. So the current ratio is pretty simple. It's current assets divided by current liabilities, and quick ratio is essentially the same thing, except it changes the top of the fraction, and we'll talk about that in a second. So current assets divided by current liabilities. Oops. Okay, so if we go back up to our balance sheet, this top section, these are all of our assets, and these are all of our liabilities and our equity. And if you remember from the accounting equation, this has to equal these two, and you'll notice that it does. That's why they call it a balance sheet. If these two don't equal, then there's some math wrong. Okay, so in this case we have to determine what are current assets. Well, what's very nice is they show you this, but in case this was not provided, if they just provided you accounts with totals, what you are looking for is something that is either cash or can, under normal circumstances, can be converted into cash within 1 year, 12-month period of time. So obviously cash is there. Marketable securities, as the name implies, these are things like 30-day, 60-day, 90-day T-bills, these CDs, these types of things that are less than a year in length. Accounts receivable, boy, you definitely want to receive all of the money that you should get from people selling, that you sell on credit for. You definitely want to get that within a year. You're probably not going to be in business if it takes longer than that for them to pay you. And then inventory, the purpose of having inventory, if you are a seller or a manufacturer of goods, is to actually make it and or buy it, and then ultimately sell it and get paid for it. So they've given us the total here, but I did want to explain how you get to current assets. Now, if you look at the rest of these assets here, investments, those are something that are usually, they're different from marketable securities, primarily because they plan on being held for longer than a year. Plant and equipment. So this is things like your warehouse, your factory building, your office building, computers, desks, chairs, filing cabinets, things that are going to be longer than a year. Another thing I just thought of here that sometimes you'll find in here also as current assets would be supplies, because those are things that are going to be used up within a year. So that may also be in turn total current assets, but it's not in this case. Same thing works for liabilities, as you have long-term liabilities, which are bills that are going to be paid for longer than a year, and then you have short-term. So here's your taxes. Accrued taxes are things that are held out of your employees' checks. Payroll taxes that have to then be submitted, sales taxes that if you're charging sales taxes, that periodically you have to pay back to the government, and so they're liabilities because you owe that money out at some point. Notes payable, this is kind of like a CD on the other side of things. This is you borrowing money for a short period of time, 90 days, something like that. And then accounts payable is basically credit, selling to your particular customers. All right, so that gives you the background, and so it's relatively easy because in both cases we have been given the total. So it's just 536 out of 181, and then you do the math. And you're looking for this ratio of 2.96 times, or 2.96 to 1 is how you can list that. And basically what this is telling you is you have almost 3 times the amount of current assets to cover your current debt. All right. Now, as we move down to quick ratio, with quick ratio you're looking at basically taking out 2 things. And that would be prepaid expenses and inventory. Now, we don't have prepaid expenses, which is another potential current asset that could be up here. But in this case, we're going to remove inventory, because the idea with our quick ratio is if I had to turn everything into cash real fast to pay bills, how much money do I really have that I can do that? Well, in this particular case, accounts receivable, marketable securities, cash is already there. So 52,200 we already have as cash. Marketable securities, because they're marketable, we would be able to instantly turn them into cash and not suffer much of a loss. Accounts receivable, you can actually factor receivables, essentially sell your receivables to somebody else for a slight discount. But if you had to get rid of all of your inventory and turn it into cash, you might have to deep discount it. You may have to sell it for half price. You may have to actually not even cover your cost on it. So we would like to try to avoid this. So that's why they do this quick ratio. So basically the 181 is going to stay the same, and it's going to be 536 minus the cost of the inventory. So if you do the math on that, that works out to be 298, 600, again divided by the 181. And now you do the math and it works out to be 1.65. Okay. So a lot of people might say, well, 1.65, 2.96, is this good or bad? Well, it depends. I mean, that's where trend analysis comes in and comparing to the industry. How does this company compare to others in the industry? And how does this number look this year compared to last year and the year before and the year before? So that's why we do those other things, because this number in and of itself doesn't really tell us a lot. That tells us that a little more than 1.5 times, 1 2/3 times the amount of current assets we have to cover our current liabilities. So that's basically what that's all about. All right, so let's move on to the next one. Debt to total assets. Oops. All right. So at this particular point, debt to total assets. Liabilities is another name for debt. So if we take all of our current liabilities and all of our long-term liabilities and add them together, or coincidentally, and nice for us, they came up with that math already for us, 322,000. All right, I don't want the underline. Get rid of the underline. You can do that for me? There you go. Okay. And then we're going to divide that by our total assets. Again, another number that's been given to us right here. Or, as I said before, it's also the same as that number right there. That's why they call it a balance sheet. 500, and we do the math. And it shows that our debt, as far as all of the stuff that has a value to us, our total value of the company on paper is the $946,500 in total assets. And so our debt, or our bills, represent 35.31% on that. Again, good, bad. I have no clue. We got to compare it to ourselves in previous years, and we have to compare it to ourselves in the industry. What's the industry deal? Asset turnover. I'll let you guys do that one. But, well, I guess I could do that for you. Might as well do all of these so you can see. So total asset turnover. All right, so in order to do this particular item, you're going to have sales revenue. which I'll give you because I don't have it listed here. So sales revenue is, again, I'm doing this particular problem 36, so 2,064,000. And when you're comparing some turnovers, that's you're figuring out how well you're utilizing your assets. So things like receivable turnover, inventory turnover, fixed asset turnover, total asset turnover is all going to start with your sales or your revenue number as the top portion of your fraction. And so then, total assets, right, we just had the conversation here. Oops, 946.5. Do our math. So our total asset turnover is 2.18 times, or 2.18 to 1. So our what we're doing with our assets, how many times, how are we using a measure of efficiency here? Asset utilization ratios measure efficiency. So for every dollar of assets that we're putting into play, we are turning that into $2.18 in sales. Again, what does a number mean? Not a darn thing unless you're going to do some comparisons and finding out, is it going up, is it going down, how does this compare to our previous years, and how does this compare to industry. And then what else do we got? Average collection period. So average collection period is another asset utilization ratio. And so what we're looking at with that is to take our accounts receivable and we're taking our accounts receivable, which is 222,000. And the reason this says net is they've eliminated the bad debts out of here. Or what bad debts is kind of shows you my age. I think they call them uncollectible accounts now. That's more politically correct, I guess. 222,000, and we're going to divide that by our average collection period in the number of days. And so, basically, what you have to do with this is again, there's a little bit of a calculation that needs to happen here. So we have to go back to that sales number, because basically you're going to be looking at the accounts receivable number divided by average daily credit sales. So you have to take your sales number, which we've identified as this 2,064,000, and you're going to divide that by 360 to get what the average per day is. Okay? And technically you could do 365. I'm not going to bust your chops if that's what you do. So we're at $5,733, and if you do the math on this, this tells you the number of days. Oops. So we have 38.72 days is how long it takes on average. Again, you'd have to check the trend, you have to check the industry, you'd have to check how does this compare to previous years of your own calculations and that type of a thing. And so if you were struggling and you were finding that the company had some short-term cash flow issues, if your current ratio and quick ratio weren't where you needed to be, this might be something that you could work on. Is it possible that I can get my average collection period down below 38.72 days? Could I get it down to 30 days? So on average I'm getting paid within 30 days, within the month. That might be what I want. Anyway, so that's 3-36. Again, if you want to complete, we've done the liquidity ratios. We did some of the asset utilization ratios. We did one of the debt utilization ratios. There's a couple more of those. There is a number of, there's like 3 more asset utilization ratios, and then there's 3 profitability ratios. If you want to take the time, and you have it, between now and especially the end of the class, when 3-36 will actually, if you understand how to do those, then that will be really good for your final paper. So, but again, I would be more than happy to reveal the solutions to you for that problem for anybody who asks for it. But there you go. That's a walkthrough of a couple of the problems related to what you guys are going to have to do for homework this week. Thanks.